So you're making six figures. No doubt you get approved for a home loan, right? Let me tell you, don't get cocky. Just because you're making a lot of money doesn't mean you can't get denied for a home loan. And the reason being is for three simple letters: DTI. Now, I'm not a boy with a bunch of math, but now we'll explain what DTI means, how us as lenders calculate it, and how you can reduce it to qualify for your mortgage loan. DTI is your debt to income ratio. Basically, is how much of your paycheck is already dedicated to other bills, such as like car payments, credit cards, student loans, any other personal loans, before we actually consider your mortgage payment. Let us use DTI to see how much income you have left that can be used towards your mortgage. Now, let's think of your monthly income as a pizza. We all love pizza, right? Then just want to see how much of the slices of the pizza is already been eaten or taken already, right? Now, the more slices that have been taken, the less income is being used towards your mortgage. Now, we don't want to put pressure on you. We don't want to discourage you at any point. But the thing is, we want to make sure you're not house poor. We want to make sure you're actually eating too and buying groceries and all that. But let's get into actually calculating your DTI. Now, DTI pretty much is your monthly debt payments as divided by your monthly gross income. Now, let's say you're bringing in $6,000 a month. Your total bills is about $2,400. That means 40% of your income is already going to your debts. Now, the rest can be used towards to qualify for your mortgage. Now, most lenders, when it comes to DTI, they want to see about 45% less if possible. If you're going 50 plus, there's a little too much risk and you're pushing it already. All right, so trying to just keep your debts as low as possible. We want to get a little more in depth when it comes to DTI. There's actually two forms of DTI. One is called front-end DTI, the other one back-end DTI. Then the front-end DTI is pretty much what the house is going to cost you. It's going to be your mortgage payment, including your homeowner's insurance, your property taxes, and any HOA fees, right? Now, as for your back-end DTI, that's pretty much the bigger picture. That's going to be your monthly expenses, right? Along with all your debts. So that's exactly what the lender is going to be looking at to qualify. You want to let you in on a few limits when it comes to like the more traditional loans, such as Fannie Mae and Freddie Mac. Those are your conventional loans. They typically go up to 50% our back end. As for FHA, they're a little more forgivable depending on your credit and the down payment you put in. They'll go maybe to mid 50s, but we do want to avoid that. Let's not go so high because we don't want to make you house poor like I mentioned earlier. I want to talk about on how to lower your DTI. There's a few ways to do this, right? First of which is eliminating some of your revolving credit. You can start off by paying some of your credit cards, right? You probably don't even owe too much in your credit cards, but what's killing you is that monthly payment. Remember, us as lenders, we don't care how much you owe overall, but we care about how much it is you have to pay every month to make sure you're compliant with your credit, right? So paying one or two of those smaller credit cards can make the difference to qualify for the amount of property you want. Another thing too, don't take on the debt. Don't take on the debt. Don't go out and buy a new car. Don't get a personal loan for whatever. Try to keep your debts as minimal as possible. If you want to buy a new car after you get your home, that's definitely on you. Another way to increase your odds is by maybe increasing your income. You can get a pay raise at your job. You can also maybe I don't know, start a side hustle or something, get a second job, whatever it takes. And also maybe bring in another co-borrower. Someone that can bring in their income. They're going to help you qualify for the property you want. All right, we went over pretty much everything there is to know when it comes to DTI. Remember, the DTI tells us your income versus your debts. Make sure to keep it under 45%, and also do not take on any new debts. All right. So if you're unsure where your DTI stands or if you need assistance with finding that out, make sure to link the link in the description. You can book a free consultation with me directly. And also, if there's anything else you want me to talk about, any other questions or any other topics you want to bring up in future videos, please make sure to drop a comment. See you guys soon.